All right, why don't we go ahead and get started? So thank you guys for joining. My name is Mark Lamonica. I look after the individual investor team here in Australia. And today we're going to talk about returns, what our expectations are for the future. Well, basically, same thing that we talked about on Tuesday night, but we're going to talk about the implications this time. So we'll do a brief overview of sort of where we think Morningstar we are from a returns going forward standpoint. And we'll talk about what the implications are as investors. But first, a couple of housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. And if you're over in New Zealand, you can review our FAP by going to our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to go talk to a financial advisor if you want personal advice. All right, so let's get started. All right. So I'm going to briefly go over what we discussed on Tuesday night for anyone who attended that. What we did is we walked through the three different sources of returns. And the notion, of course, is that we all get caught up in a lot of noise and data and predictions for the future. But sometimes it's nice to take a step back and look at where the returns actually come from. And then we can assess where we think we are right now. So there are three sources of returns on shares. Dividends, so of course, cash payments that are made directly to you, traditionally have been a very big source of return. So close to 70% of ASX returns have come from dividends. So this is important. And if we go back and we look at the dividend yields, of course, the dividend yield is the amount paid out in dividends divided by price. So as prices go up, all things being equal, dividend yields will go down. We go back and we look in the 1980s, the average dividend yield on the ASX was north of 4%. Currently, we're sitting below 3%. So when you think about the implications for future returns, if dividends are a huge component of that, then lower dividend yields do not point in a good direction for returns. The other thing that, of course, can happen, and we'll spend some time talking about this, is changes in valuation level. So, of course, the amount that investors willing to pay for a dollar of earnings or any other piece of valuation, cash flow, et cetera, dollar of earnings is, of course, going to drive returns when it changes. So if investors are willing to pay more for every dollar of earnings, that will add to returns. They're all of a sudden going to pay less for every dollar of earnings. That, of course, subtracts from returns. So changes in valuation level also impact returns. So since the 1980s, the average monthly PE ratio of the ASX has been around 14. We're at around 28 right now. So you see, we are historically high. Now, whether that's justified or not by interest rates, which we're about to talk about, that is still something that we need to take into account as investors, that even if this elevated valuation level continues forever, we still will not get the positive influence from those changes in valuation level. Then, of course, earnings growth. So if people are willing to pay the same amount for a dollar of earnings, of course, earnings can grow. So this is where, of course, we need to turn to our analysts, because this is predictive of the future. So if we go back and we look at the ASX 50, so we looked at the top 50 shares. Now, remember, for any index, whether that's the 200 or the 300, because it's market cap weighted, the top 50 have a disproportionate influence on that. So earnings grew around 5% a year over the past 5 years. Looking forward, our analysts expect that earnings growth to come down, and primarily because of some concerns that they have around the resources sector. So coming down to 3% over the next 5 years. So we're also looking at lower earnings growth. So basically what the picture that this whole thing paints is that I think objectively we can probably take a step back as investors and say that it's unlikely or less likely that returns that are going to happen in the near future are going to approximate what's happened in the near past. We have to remember that we have been on a very good run. We'll get into some of this. And there could be concerns going forward. Now, two things could happen, obviously. There could be a large drop, which would reset dividend yields and reset valuation levels, or just slower, or it could be a combination of both, or just lower returns going forward, returns that potentially are below earnings growth, below dividend growth, so that yield once again ticks up and valuation levels come down. So there are lots of different possibilities if this thesis is correct. Of course, the other thing that could happen is returns could look exactly like they have been recently, and the market could continue to go up, and this valuation level would continue to go up, and the yield would continue to go down if share prices appreciate faster than earnings and faster than dividends. We would see both of those things happening. So basically what we're saying is that has happened, that share prices have outpaced dividend and earnings growth, which is why we're seeing changes in valuation levels and yields. And there's a lot of reasons why that could be justified, which we'll get into in a second. But anyway, that is a thesis of what we're talking about today. Of course, I can't predict the future. Nobody can. But this is trying to take a step back and looking at some of the factors that could influence future returns. All right, so let's look at what past returns have been. So our analysts went back 10 years and they broke returns of the ASX 200 down into three different components. So they looked at price returns. So price returns are just obviously the changes in price, should be obvious. So those can be driven by earnings growth and valuation level changes. So approximately over the past 10 years, 5% a year in just pure share price changes. Then when we start looking at dividends, all of a sudden we jump up to 9% a year. So you can see the influence that dividends have. And then when we start incorporating franking credits, up to 11%. So 11% a year for the past 10 years. And just the reason we want to look at this, because if the thesis is that returns will come down in the future, we should see at least what they were in the past. All right, why has this happened? And we're going to look at longer term returns in a second. Why has this happened? What's the overall environment that for most of, well, in this case, I think everyone's lifetime from an investing standpoint, what has happened? Why have returns been so strong recently? Well, one thing, if we go back towards the early 80s, and we look at both inflation and interest rates, we can see the Consumer Price Index. This is the US, but this has been matched pretty much everywhere around the world. And then here are 10-year US Treasury bond yields. You can see we've had this incredible environment where interest rates have gone down and inflation's gone down. So we're going to do a whole webinar on investing in an inflationary environment next week. But both these things are very positive for investors. So interest rates coming down are very positive for investors because they generally make valuation levels go up. So for those that have attended the How to Value a Share webinar that we have on our website, we know that when we are valuing shares, we project values out into the future, we project cash flows out into the future, and then we bring them back, we discount them back to the present day using a discount rate. That discount rate is driven by interest rates. So if the discount is lower and interest rates are lower, those future cash flows will be worth more. This also obviously has been a great environment for businesses to operate in. So certainly businesses that need to fund themselves using debt markets, they have been able to go out and access cheaper funding. Now, normally what we have been told is that when interest rates go down and the money supply goes up, we should have inflation, but we have not had inflation. We have been in a very low inflationary environment, as you can see, sort of sub 5 from the early 80s, and then basically well below 2.5 for the most part since the year 2000. Now, a lot of this, of course, is based on some other things that have been going on in the economy during this whole time. We've obviously had technology. So technology that makes it more efficient for companies to operate, of course, is going to bring inflation down. We've seen a lot of offshoring where cheaper manufacturing overseas, and companies have taken advantage of that. So there's all sorts of reasons, and we'll go through a lot of them next week. Everything from unions losing power, all sorts of different things that we can point to as to why inflation has been low. But anybody who has been reading the news, and this is why we're trying to do this inflation webinar next week, will a lot of central banks have come out and said, and economists have come out and said that it is transitory, meaning that these are little blips of inflation as we come out of lockdowns. It continues to be higher than expected. If you look at the US, they just reported September inflation, once again, over 5%. So there are increasing worries that this is not, in fact, transitory, and we could be moving into a higher inflationary environment. So what would that mean? We'll talk about it next week, but it will also mean interest rates would probably go up to combat this. So this environment has been very, very good for investors. So when we look at returns that we've achieved since the 80s, we do need to be cognizant that we've been operating in a very, very favorable environment. If that favorable environment changes, then once again, we could see changes in future returns, lower future returns than we've received in the past. All right, so this is looking at the S&P 500 in the US, and I think this is a really interesting chart. So if we go back and look at 10 years, we've got two different returns on here. We've got an annualized return nominal, so think of that as just, the actual return you're getting. Then we take inflation out of it, real returns. Real returns are what we care about as investors, right? Because the reason that we are saving and investing is because it's simply delayed gratification, right? We're doing that so we can spend the money later. So whether that's spending the money in retirement, whether that's spending the money on any other goal that we have, we want to spend the money later. This isn't some academic exercise. So real returns matter, because if there's inflation, it's going to cost more to buy whatever we want to buy with our goal. So if you look at the 10-year period, you can see if we look at either side, real or nominal, but especially real. So really, really strong returns. This is through the end of 2020. That was a typo by me. So close to 12%. So this is the return environment that people are used to at the end of the day. And remember that as humans, we fall victim to recency bias, meaning that things that have happened more recently will influence our thinking about what is going to happen in the future. Then we go back and we look at 30 years. So now we're going back to the early 90s. All of a sudden, still good, but not as good from a real return perspective, right? 8.3% instead of close to 12%. So we're talking almost like a 4% drop there, a little less than 4%. Then if we go back 50 years, now we are taking into account the 70s and early 80s, where we did see high interest rates and interest rates going up to combat inflation, which was also going up. So remember, if we go back here, we're looking at the 70s. This is the consumer price index, this line right here, whatever color that is. I'm colorblind. But you saw these sort of surges in inflation, right? So this one around the mid 70s. And a lot of this was driven by energy. If anyone's read the news lately, what's happening now? Energy-driven inflation. So yeah, we saw this spike here. We saw this spike in the early 80s, and interest rates followed, right? So interest rates were raised quite significantly here. So this, of course, is the US. So this is the whole Volcker Fed beat inflation now, early in Reagan's presidency. We saw huge spikes in interest rates to get inflation under control, and it worked. Right? It worked. But if we start looking at this return environment, it was not very good for investors. So now we're going back. If we look at 50-year returns, we're at 6.8%. All right. So if we average these out, it is a lot lower than what we've received recently. And of course, mathematically, we know that if you get above average returns for a long time, if it's going back to the average, we're going to have to get below average returns. So once again, maybe a concern when we think long term about what is going to happen. All right, so what's the implication of these returns. So, I see a lot people forecasting out, whether they're projecting their portfolio out or just making general statements about what you can earn investing. I see them using very high numbers. This is not any sort of scientific study here, but 10% seems to be something that is quoted quite frequently. Now, 10%, obviously, when we're sitting here looking in this environment, is pretty good. From a nominal return perspective, yeah, right around 10%. But remember, we care about real returns. And we've all sort of forgotten about inflation because we haven't faced it a lot. So we do need to remember that, and we'll talk about this next week, we do need to remember that in high inflationary environments, of course, your real returns are likely to go down. So I always see people quoting 10%. And I personally don't think that that's probably realistic going forward over a long time period, but wanted to just look at the difference in an investor earning a 7% return versus a 10% return. I'm assuming a $100,000 portfolio, but obviously any number you put in there, you're going to see the same impact, and saving $5,000 a year. So over a 10-year period, you can see the gap, right? So this is what you'd have. 265K with a 7% return, 339K. And of course, this gap increases due to compounding as we go out to longer time periods. And so what I put in here in the italics is how much you would have to save a year to make up for, in this case, a 3% return gap. So instead of saving $5,000 a year over 10 years, you need to save double that, more than double that, to make up for that return gap. So remember, even seemingly small differences in returns, I wouldn't necessarily call 3% small, but still, even small differences in returns are going to have huge impacts over time because of this impact of compounding. So we go out to 20 years, all of a sudden you're saving $14K a year and then over $19,000 a year versus $5,000. So big jumps, right? Big jumps between what you need to save to make up for these returns. The other thing, of course, you can do that if you're saving for a goal here, whether that's retirement or anything else, is you can, of course, delay it. So extend the time period until you want to achieve your goal or until you achieve your goal. And that will have the same impact as well. But, you couldn't model out everything, right? We don't have all day. So implication is, of course, lower returns are going to have impacts on your long-term portfolio value. If you still need to achieve the same goal, you need to think about what are the different levers you can pull and the different changes you can make. Okay, really good question by Carrie. Has tax been taken into account? No, so I've not taken tax into account, and I've not taken fees into account either. So if we go back and we look at, so I have it on here. So, whatever we want to call this, this is a 7% return after tax, after fees. That's a 10% return after tax, after fees, which of course make it more difficult. When we go back and we look at these returns, both the nominal and the real, yeah, these do not take into account any taxes or any fees. So that's something that we bear as investors. So another thing that you need to take into account. And once again, also when people are quoting these numbers like 10%, remember that's what they're quoting, right? Like you need to earn that as an investor. You need to earn that after you paid your taxes, after you paid fees. So yeah, pretty important. That's a really good comment, Carrie. So what can we do? And we have first on this list, what can we do as investors to try to deal with some of these issues? Well, number one, in lower return environments, you need to be especially cognizant of fees and minimizing your taxes, right? Because those are still big costs to you. The percentage of those costs will be larger in a low return environment, right? So if I'm somehow paying 1% a year, to earn my returns, yeah, it's a lot larger percentage if overall returns are 7% versus 12%. So all of a sudden that 1% is taking up even more. Not that you should ever probably pay that much in fees, but fee and tax minimization, it will make a bigger impact. Looking at your required rate of return. So of course, as I preach over and over and over again, If you're trying to get somewhere, you got to figure out how you're going to get there. And the way you get there as an investor is a required rate of return. If I want $1 million and I got $100,000, I'm going to get there from saving and over time, but that return matters. I should know what that return is, because that, of course, will tell me if my goal is realistic. So if I'm going to have to earn 20% a year to get to my goal, then it's probably not going to happen unless you are a lot better investor than I am, which is likely. But review your required rate of return, make sure it's realistic. Make sure, and once again, like, I don't want lower returns. I think people do get in this mindset where they are bullish because they have shares. I guess that's fine, but no amount of you talking and hoping is going to change what's going to happen in the future. And if this whole thing doesn't happen, like, you just get rewarded with more money. At the end of the day, right? But looking at your required rate of return to make sure that goal is achievable is pretty important, because there are things you can do, of course, to make the goal achievable. That is, save more money is the big one. Save more money. Look at the period of time until the goal and see if that can be extended. There are different levers that you can play with. And if you do save more money, I get that you are giving up spending right now. If you do save more money and returns happen to be higher, well, good for you, right? You'll just have more money. All right. We're looking overall at the market. So obviously, when I'm looking at those dividend yields, when I'm looking at those valuation levels, we're looking at overall market measures. But of course, that doesn't necessarily mean this is your portfolio. So there is the opportunity, obviously, for you to focus on the valuation levels in your own portfolio and the dividend yield in your portfolio, because that's all that really matters. Now, the caveat to all of this is lowering your valuation level in your portfolio by buying crappy shares that are trading really cheap is not exactly a good strategy. Same thing, buying very high yielding shares where that dividend may or may not be sustainable and will not grow, most likely. That's also a bad idea. So this comes with a caveat that you obviously need to spend some time doing some analysis here. If you are in retirement or if you are approaching retirement, think about withdrawal rates. So obviously, if you're taking 4% out of your portfolio and your portfolio is returning 7% a year, that's a little different than if it's returning 10% a year. So just be cognizant of withdrawal rates, especially if you have more aggressive withdrawal rates, what the impact would have on longevity risk, basically the risk that you die or you run out of money before you die. And then look at asset allocation. So once again, make sure that, we're looking just at share markets here. Now, I don't think the return environment's great for bonds either, and we'll talk about that in a second, but we're looking at just share markets. Your portfolio probably isn't 100% in shares. Maybe it is, but that means the more defensive assets you have in your portfolio, that will lower your expected return again. So just think about that. And particularly around sort of bonds, share and bond correlations, anything that you read around diversification tells you this very simple story. And that very simple story is, bonds are great because when shares go down, bonds go up and vice versa. That's not actually true. So if we look at this same environment, what are things that impact bond prices? Well, one thing is interest rate levels. So as interest rates have come down, bond prices have gone up. So bond returns have actually been very, very strong. And there's I don't think it was famous, but I like the article. There was an article, I think at the end of May in 2020, that was showing over like a 20-year period that long-term U.S. Treasury returns were actually higher than share market returns. And the reason for that, of course, is there was a huge drop around COVID. So they're taking advantage of what happened during COVID. You can come out with all sorts of interesting stats when the market has fallen 30%. But just remember that bond returns have been very, very strong. They are also less likely to be strong when we're starting at very low interest rate levels. Because, of course, if interest rates go up, bond prices go down. So in many ways, as the share market has surged over this time, and the bond market has surged, there has been a high correlation between positive returns. So you're not getting this sort of diversifying impact that is just talked about in sort of textbooks about investing, where shares go down, bond prices go up, and that's how you protect yourself. So we have not seen that actually happen. Anyway, thank you guys very much for joining. I will be back Tuesday. I don't remember if it's Tuesday or Thursday, but we are going to do one on inflation next week, which I think will be interesting, hopefully. All right. Thank you, guys.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.